So the big question is this: how do investors like us, who don't have a PhD in finance or millions to start investing, how do we grow our bank accounts to build real savings and retirements, and yet still have the time to do what we really love? That is the question, and this podcast will give you the answer.
All right, awesome. Okay, so we're all back. All right, see, so the stock goes down a whole bunch yesterday. I mean, just straight up, or today, right? It's insane. And so, obviously, since the stock goes down, the puts are gonna like skyrocket, right? So yesterday, these investments were totally screwed because they were all puts. They're down a whole bunch. But now they're up like 380% today. So like this is the thing with options and the volatility in options. Like my portfolio is probably up like 6 or 7% today because it's like probably maybe a 20% stake overall in options. And like these, it went from like $7 to like $1, and now it's at like $3. And so it's just this it's so much more volatile. And it all stems from like this idea that you're leveraging yourself, right? And so what I thought was like more interesting, though, this is kind of what I want to focus on, where was the difference between like the calls and the puts after this happened. Because like yesterday the calls were down even though the stock price went up, and today the calls are down like 75%, like for all of them, right? And so like you lose money both ways. Like what the heck, that's insane. So like a straddle would have like gotten screwed on this, and the reason why is not because of the price, but it's because of the expected underlying volatility, because people thought that the stock was going to move so much more than it actually did. And so like because of that, it's weird, but like their earnings being mediocre like just destroyed the time value of the option, right? Because the time value is based on what? The time value is based on the amount of volatility. And so it's this idea, there's like this the options pricing formula, right? And I go into it so much more in like the options courses, but like this idea, like the only thing that matters is like the volatility, and then the difference between the strike price and the spot price. And the volatility, the implied volatility, is like what the market determines when they price the option, right? So these fluctuations in prices that are extremely fast, maybe like half of it is like actual underlying price change, because today the stock it's down $20, and so like it should make sense that like there's a dollar movement in the price, since the options are $10, the stock's $300, so it's about maybe like 3%. And so like a small amount of that $20 change, maybe 3% of it, should be accounted for in the actual price change. So 3% of $20 is less than $2, less than $1, right? Small amount. And so like a vast majority of the percent change and a vast majority of the movement is based on the underlying changes in perceived volatility and what people think the stock is going to do, right? It's all about what people think it's going to do. Just like what makes the stock go up versus what makes it go down. Like it's buying and selling pressure that comes from what people think it's going to do. Like the earnings reports or the underlying revenues. Like revenues don't determine stock price. If the company makes X much money and then they make X much money later, and maybe that's 10% more money, that doesn't mean like the stock's going to be up 10%. And so that's why like a lot of people, they only focus on fundamental analysis, and it freaking like just doesn't work, right? Because you need to have a technical balance in some parts of everything that you do, because like if you can't read the charts and if you can't understand what's like really going to happen, then you'll be out, right? You'll be out of your positions, you'll be out of your pants. I mean, you'll be screwed, because it's all based on the actual movement of the price. And so that's why like when you look at these options, right, like you're using technical analysis, right, to figure out the dollar value and the dollar parts of the movement. But on top of traditional analysis with just like normal stock trading, where you have to figure out is it going to go up or down, with options you need to analyze. It's so freaking crazy, but like you need to look like at the break-even point. So like this idea that, where's the break-even, and then different strike prices break even at different places. Well, why is that? Well, it's because of a difference in what people think about the asset, how they predict that it's going to move, and how volatile they think it will be, right? And so that's constantly changing. And so like when you look at trades like Netflix, when you look at these options investments, you got to make sure like you focus on what matters, right? And what matters is the public perception. And so you can determine that, right, by looking at like how much of a premium you're paying for the amount of time that you're in it. So like with Netflix, like these options that expire in like a month basically, right? At least the ones we were looking at yesterday that we bought, they break even extremely, the calls break even very close to the current price. And the puts break even, probably about 3 times further away from that. And they're up like 500% today. And so like when you see that the break even point is very close to the current price, or in other words, like the amount of money that you pay for the option, when you subtract the strike price from the spot price, and then you compare that to the premium. If you're paying like $1 and the strike price is $1 away from the spot price, then there's like literally 0 time value. And so what you usually see like with these Netflix ones, right? The share price is like what, $275 right now or some crap like that. And these 270 puts break even at 266, right? And so like you've got to have like what, a 3% move to make money on that. And so obviously you want to have like a 3-to-1 or a 4-to-1 or a 5-to-1 or a 6-to-1 risk reward ratio. And the way you get that, right, is by looking at the actual change in the price, right? And by focusing, and so like because there's a big difference, like that's what, like $8-9 difference between the current price and the break-even point versus the calls at that same price level, that 270 call, which is out of the money. So I guess a better comparison would be the 280 call. 280 call, instead of being like exactly the same, it's like the other way around, right? So it's inverted. So if it hits that point, then it's gonna break even, but not for the downside. It breaks even for the upside, and it's also $9. And so a lot of times you'll see like differences, right, where it's maybe $5 down with the difference versus being something like $20 up, right? And so if the calls are $5 to break even and the puts are like $20 to break even, then there's like this insanely high premium on the downside on the puts, right? Because people think that those are going to go down. The stock's going to go down, right? You can look at the differences in like the actual underlying investments, and kind of more importantly, the perception of them. And that perception is basically contained almost in its entirety in the time value of these options. So that's like the big key takeaway is, obviously you have to look at break even, and obviously you have to look at price change. And as you trade these, you trade them mostly on like technical setups, right? Because most of them are like swing trades. And so you're focusing on like where you think the stock is going to go. But what's also like super important is, that you look at the difference between calls and puts, and then especially the ones that are close to the strike price, they're like immediately at strike, and you look at the pricing differences between the puts and the calls, right? So you have to understand that like if there's a huge difference in pricing between the two, then the market is very biased. And remember, a vast majority of the time, most people are wrong. And so if most people think something's going to happen, usually they're wrong. A great example with this past earnings report on Netflix, all the analysts, like every single analyst, said they were going to be amazing and they were going to do the best thing ever, and they were going to have the best earnings season ever. And they literally missed on every single number except for subscriber count. It looks like they're still screwing up on that. And so, like, most people are usually wrong. It's the same thing with NVIDIA. I remember every single person on the planet said that their stock was going to be crap, their earnings are going to be terrible. And then they reported, and like within like a week, they were up 40%, just absolutely crushed it, right? And it's this idea like the majority is usually wrong. And so, like, when you look at these options, right, with Netflix right now, they're basically the same, $5 for a call, $5 for a put. And so there's no there's no upside here, right? Like, even if I go out into like further and further away time periods, it's $10 for calls, $10 for puts, $16 for calls, $16 for puts. As you increase the time frame, obviously the time value increases. But like literally right now, it's for these options that expire in like 5 months, they're like $45 for calls, $45 for puts that are like very, very, very close to the spot price. And so because there's no bias, because there's no trend, because there's no direction, it basically shows that no one knows what the hell's going on. And because no one knows what's going on, that's really the only point where you have nothing to work off of. You have no contention. You have no pressure. You always want pressure. You always want a split marketplace. Because if everybody's happy-go-lucky and just thinks that it's going to stay where it is for the next 4 years, like, that's total crap. Unless they're paying like a 10%, 15% dividend, you don't want to take part in that, right? You want to be in the stocks that have pressure and tension, and you want to get on the right side of that tension and make the most profits possible, while also like highly limiting your downside and your risk, in case you're on the wrong side, so you get out before stuff goes freaking wrong fast. And that's like the whole principle behind active trading and the technical setups and techniques 9 to noon, and like everything stems right from this idea that you want to have maximum upside, minimum downside, and outperform 99% of investors by like focusing on what freaking works, which is just like so cool. So just like some really awesome learning experiences this week so far with Netflix, and it's been really awesome. Trading has been great. Today was pretty sick. There was this one, what was it? It was like ATIS. Oh, and Bingo. Dude, you guys remember Bingo from yesterday? They went through another ABCD setup today, which was like sick. So that was like a 15%, super easy, right off the books, ABCD. I had one day trade today, so I used my day trade on ATIS. And what I did was a little bit of a mistake. I got in right off the bell, and then they dropped a little. I got stopped out, like down 2%. And then they went up like 36%, which was like freaking sick. So I just had to be a little bit more patient, because a lot of times you try to buy like right off the bell and it just doesn't really work well, especially if the first candle is a red candle. And so you have to just give it like 5 minutes to have a nice breakout and a setup, because they were in a wedge like pre-market, and then they broke out of that wedge, which was like awesome. And it was a downward wedge, so they broke out of that after a very hesitant first couple of minutes of trading, which is where I stopped out. They came back up, they broke out of the wedge. They absolutely crushed it, which was awesome. They did an amazing job today. So a lot of really cool stocks, and really like just freaking, it was super fun, like best day ever. So I'm super excited about it. I gotta go to CS and like learn to, I don't freaking know. I think we're doing stuff with like file writing, which is cool, I guess. I don't know, man. We'll see. So hey guys, go out there, crush it, have the best time ever. And look at like the differences in options premiums for calls and puts, because that's going to show you like obviously, right, you can look at the actual price differences between the spot price and the actual price of the option, and then therefore like the break-even price. But it's just so much easier just to compare the two, because you compare the two, you're going to inherently look at the time value, and kind of more importantly, like obviously there's time value, but you're going to be able to see the difference in time value between calls and puts, and that's going to let you understand like the actual bias that most investors have towards it, and sort of validate any technical setups, right? So if the technical setup says it's going to go up a whole bunch, and then like everybody is buying calls, then it's like, hey, that's pretty freaking good. And similarly, like if it's going to go down a whole lot and everyone's buying calls, you can use it as sort of like a ulterior indicator, this idea that like most people are wrong, and so you can go against what a lot of them say. And usually, like if you do that, you can get super cheap entry points. I mean, you get really cheap entry points, but really high leveraged upside. You can make a lot of money really quickly. Great example of this, and I think I'll finish on this because it's super powerful. I mean, if you guys, I think I've talked about it before, like this movie that's called The Big Short, right? Freaking like sick movie. It's about these guys, right? and they were like in the know. They were in the game, and they were like super pro. And they basically like predicted the housing crash because they were in the housing market, and they could see all these banks giving out subprime loans that were total shit, and all these people like insuring them, and they basically like saw the financial crisis of '08 coming, and they freaking knew it, right? And so what they did is they took like their life savings as a collective group of like 5 or 6 people, which was like tens of thousands of dollars, but not like an insane amount of money, not like millions of dollars. And they took this money and they like shorted the housing market. And what was crazy is like, you know, when you're going against the masses, like everything's ridiculously cheap. And so for them, short the housing market, it was like ridiculously cheap. And they got huge, like 100 to 1 type leverage. And when everything went south, right, and everybody, because at the beginning, like everyone said they were wrong. Everyone said that they were crazy and stupid to do this. And they just sat, put their hands in their pockets, said, okay, yes, sir, understood. And then they bought, you know, their contracts to short the housing market. And because of that, what happened? Well, they made like literally hundreds of millions of dollars, like in the span of just a couple of, you know, months, during the crash, right? They turned this teeny investment into massive amounts of wealth because they were so highly leveraged and they were all in and they were 100% on getting this this short. And because of that, like they absolutely crushed it, right? They changed their lives and they'll never have to work again because they made this one investment. They changed absolutely freaking everything because they had the information, they had the foresight, and they had the knowledge to make it happen. You might be thinking, well, I don't know, how am I going to predict the next housing crash or something like that? But think about it like this, okay? There's like a ridiculous amount of I'm pretty sure it's Japanese debt. I know I made a whole thing about this. It's so cool. And it's this idea that like the government there in Japan is just printing out tons of foreign or of domestic debt and taking in and buying tons and tons of foreign debt. And so it's totally crushing their economy because like there's like rampant like everybody like that invests, at least the vast majority, like they're investing in like local government bonds, and the government bonds pay like literally nothing. And they're like hundreds and hundreds of millions, billions of dollars in these government bonds. And some of them actually return like a negative interest rate to hedge against inflation. That's how bad their economy is. And it's just like they have so much debt that like any teeny little incremental increase in the interest rates can like totally, like literally destroy their economy and make them go bankrupt because they won't be able to afford to pay all their debts to foreign nations. And all it would take is just a teeny increase in their interest rates because they have so much debt that they've accumulated over such a long period of time because they were just kind of like irresponsible with you know, they still get way too much freaking debt, right? You can't do that, you know? And so, you know, when it gets to the point that like any little increase in interest rate happens for the debt that they pay, like their whole economy collapses, right? And the idea is that, you know, you can buy shorts on the Japanese economy for like, you know, 3 cents on the dollar. It's just ridiculously cheap, just like it was in '08, because nobody thinks it's going to happen. Nobody believes in it. No one understands the threat here, right? And this is talked about so much more in Tony's Money Master the Game, which is like freaking sick. But this principle is just so huge because like you can turn this teeny investment into such a huge, massive upside. And it kind of all stems from their ability to go out there and absolutely crush it, which is so cool. And so like, because like if they're right, nobody thinks they'll be right. Nobody thinks the economy in Japan will crash. Nobody believes it. So like you turn this very nominal like amount of money into a ton, right? Because it's just such a cheap asset because everybody is on the other side of the fence. Everybody's on the other side of the game. And so everybody's buying the safe ones, what they think is safe and what they think is the normal ones. And like because of that, what happens? Well, like the investments, you know, they get pumped up. And yet, if you just go on the other side of it, and you just put a little bit down on the other side of it, all of a sudden you're getting like literally hundreds of times the upside for a fraction of the investment. So it's just really interesting. It's really crazy because when you go against what everybody believes in, like so often, you know, it's not like in all markets, right? Like it's not like, you know, go and buy crap penny stocks or stuff like that where nobody's going to have control over them. But it's in like things where you can predict and you know, and you have like the facts, the cold hard information that will change everything. And for these guys, that's exactly what they have. And it's just really cool. So a lot of really awesome stuff this week. Tons and tons of amazing opportunities. There's just always constant opportunity in the marketplace. It's so cool. I love it. So go out there, guys, apply it, invest in it, absolutely freaking crush it. And I will see you in the next one. Thanks. Bye.
Want more stock market secrets? If so, go get your free copy of my best-selling book, 9 to Noon. You can get your free copy plus $11,176 of unannounced bonuses it took me years to uncover completely for free at 9tonoonsecrets.com. Inside 9 to Noon, you'll find the top 38 secrets you can use to double your portfolio every 2 years and make upwards of 10% per trade daily.